Stop what you're doing. Put down the phone, stop scrolling through TikTok, and listen to me. Because right now, you are probably doing something that makes me absolutely sick. You are treating your money with disrespect. You are letting inflation eat it alive, or worse, you are gambling it away on speculative trash that has zero chance of ever returning a dime of profit. I'm Kevin O'Leary. You know me as Mr. Wonderful, and I didn't get that nickname because I'm nice. I got it because I told the truth about money when everyone else is lying to you. I didn't build my empire by being lucky. I built it by understanding one fundamental truth. Money is my employee. Every single dollar I have is a soldier. I send them out into the world every morning with one mission: go capture more dollars and bring them back to me. If they don't come back with prisoners, I fire them. I don't own stocks that don't pay me. I don't own businesses that don't make money, and I certainly don't listen to the noise from people who have never run a profitable business in their lives. Today, I am going to share with you the 2 stocks that I will buy right now. Not tomorrow, not next year. Right now. If I had fresh capital sitting in my account today, this is exactly where it would go. These are not exciting, to-the-moon lottery tickets. These are boring, cash-generating machines that will pay you while you sleep. But before I give you the keys to the kingdom, I need to know if you are actually serious. If you want to learn how to build real wealth, not internet wealth, but real generational wealth, you need to subscribe to this channel right now. Hit that button. Join the Cuban mindset community. Yes, I know, Cuban mindset. Mark is a friend, but let's be honest, today you need the wonderful perspective. So subscribe, turn on notifications, and pay attention. The macro environment. Why fear is your friend. Let's look at the world right now. What do you see? You turn on the TV and it's a disaster. Inflation is sticky. Interest rates are high. There are geopolitical tensions everywhere. People are screaming about a recession. They are screaming about a market crash. And you know what I did when I saw that? I smile. I love fear. Fear is fantastic. Fear is the only reason you can buy $1 worth of assets for 50 cents. When the average retail investor panics, they sell. They sell good companies. They sell bad companies. They sell everything because they are emotional. I am not emotional. I am cold. I am calculated. And when I see quality businesses trading at a discount because you are scared, I step in and I buy. That is how you make money. You don't make money buying when everything is green and everyone is happy. You make money buying when there is blood in the streets. But you have to be selective. You cannot just buy anything. In an environment with high interest rates, capital is expensive. Money isn't free anymore. So companies that have debt, they are going to get crushed. Companies that don't make a profit, they are going to zero. The only companies that survive this environment are the ones with pricing power. Can they raise prices without losing customers? Cash flow. Do they actually put money in the bank? Moats. Can anyone else do what they do? The 2 stocks I'm going to break down for you today check every single one of those boxes. And most importantly, they pay me. They pay a dividend. If a stock doesn't pay a dividend, frankly, I'm not interested. Why should I take the risk of owning your stock if you aren't going to share the profits with me? That's a bad deal. And Mr. Wonderful doesn't do bad deals. Stock number 1. The energy income beast. Let's start with the first stock. This is a play on something that the world is trying to ignore, but simply can't. I'm talking about energy infrastructure. Now, I can hear you already. But Kevin, what about the environment? What about electric cars? Isn't oil dead? Stop it. Grow up. Look at the data. We are moving toward renewable energy, yes. But that transition is going to take decades. It's not happening overnight. In the meantime, the world runs on oil and natural gas. When you charge your Tesla, where do you think that electricity comes from? It comes from a power plant. And what powers that plant? Most likely, natural gas. When you heat your home in the winter, that's natural gas. When you buy plastic products, that comes from petroleum. The stock I am buying is a midstream pipeline company. I love the midstream business model. It is my favorite kind of business. Why? Because it is a toll booth. Imagine a highway. You want to drive from point A to point B. You have to pay a toll. The toll operator doesn't care if you are driving a Ferrari or a beat-up Honda. They don't care if you are happy or sad. They just care that you drive through. Ka-ching. You pay. This pipeline company is the same. They own the pipes that move energy across the continent. If ExxonMobil or Chevron wants to move their product to a refinery, they have to use these pipes. They pay a fee based on volume. This is critical. They get paid on volume, not the price of oil. If oil prices crash to $40, people still use oil. The volume is still there. If oil goes to $120, the volume is still there. This protects the company from the volatility of commodity prices. It makes their cash flow incredibly stable. The moat, why they are untouchable. Now, let's talk about the moat. A moat is a castle's defense. It stops competitors from coming in and stealing your lunch. This company has one of the widest moats in the entire market. Why? Because you cannot build new pipelines anymore. Try it. Trying to get a permit to build a new major pipeline in North America today, it is a nightmare. You have environmental protests, you have lawsuits, you have government regulations. It takes 10 years and billions of dollars, and you still might get rejected. What does that mean for the existing pipelines? It means they are monopolies. They are the only game in town. Their assets become more valuable every single day because supply is limited. That is the definition of value. The dividend, show me the money. But here is the reason I really love this stock, the yield. Right now, this stock pays a dividend yield of over 6%. Let that sink in. You go to a traditional bank, they give you pennies. You buy this stock and you become a partner. They send you 6% of your investment back to you in cash every single year. And this isn't a trap. Sometimes, a high yield means the company is in trouble. But here, the cash flow covers the dividend easily. They have distributable cash flow that is far higher than what they pay out. That means the dividend is safe. In fact, they have been raising the dividend. I love dividend growth. It protects my purchasing power against inflation. So here is the strategy with stock number 1. I buy it. I hold it. I collect the 6%. And I do not spend that money on a new watch or a fancy dinner. No. I take that 6% and I buy more shares. It's called DRIP, Dividend Reinvestment Plan. When you reinvest a 6% yield, your wealth compounds exponentially. It's a snowball rolling down a hill. It gets bigger and bigger and faster and faster.
This is the boring, unsexy way to get rich, and it works every single time. Stock number 2, the healthcare royalty. Now, let's shift gears. The first stock was about high income and stability. The second stock is about certainty and growth. I want you to think about the one thing that no human being can avoid. You can avoid taxes if you're smart or lucky. You can avoid bad relationships, but you cannot avoid aging. We are all biological machines, and machines break down. When you get older, parts wear out. Knees, hips, hearts, eyes. The second stock I'm buying is in the healthcare and medical device sector. I look at demographics. Demographics are destiny. Right now we have the silver tsunami. The baby boomer generation is the largest generation in history with the most money, and they are all retiring. They are all turning 65, 70, 75. What happens at that age? You need healthcare. You don't want healthcare. You need it. This brings me to a concept I talk about on Shark Tank all the time. Non-discretionary spending. If we go into a recession, you are going to cut your spending. You will cancel your Netflix. You will stop eating at expensive restaurants. You will delay buying a new car. But if your doctor tells you that you need a new heart valve to live, you don't say, "Nah, I'll wait until the economy gets better." You find the money. You get the surgery. Healthcare is recession-proof. It is immune to the economic cycle. The business model, razor and blade. The company I am looking at is a giant in the medical device space. They don't just sell the machine, they sell consumables. Think about a razor and a blade. You buy the razor handle once, but you have to keep buying new blades every month. This company sells the robotic surgical systems to hospitals. That's a big one-time sale. But then, for every single surgery performed, The hospital has to buy new instruments, new sterilization kits, new accessories from this company. That is recurring revenue. I worship recurring revenue. It allows me to sleep at night because I know exactly how much money is coming in next quarter. The moat. High switching costs. Let's talk about their moat. Why can't a competitor just come in and make a cheaper version? Because in healthcare, price is not the most important thing. Trust is. Surgeons train for years on specific equipment. They build muscle memory. They know exactly how the machine feels. If a hospital administrator comes in and says, "Hey doc, we found a cheaper machine from a startup," the surgeon is going to say, "No way. I'm not risking my patient's life on unproven tech." Once this company gets into a hospital, they never leave. The switching costs are too high. That is a fortress around their profits. The financials. Now let's look at the numbers. Mr. Wonderful loves numbers. This stock doesn't pay 6% like the energy stock. It pays closer to 2.5% to 3%. But that's okay. Why? Because it is growing faster. The energy stock is a slow-moving cash cow. This healthcare stock is a growing compounding machine. They have a pristine balance sheet, minimal debt, billions in cash, and they are a divided aristocrat. That means they have raised their dividend every single year for over 25 years. Through the dot-com crash, through 9/11, through the 2008 financial crisis, through the pandemic, they raised the dividend. That tells me the management team is disciplined. They prioritize the shareholders. My analysis. Here's why I'm buying this now. Recently, the market has been punishing healthcare stocks. People are worried about new weight loss drugs, like Ozempic, making people healthier so they won't need surgeries. I think that is nonsense. Even if people lose weight, they still age. They still have genetic issues. They still need an accident fixed. The market has overreacted. The stock is trading at a valuation that is reasonable. It's not dirt cheap, but quality is never dirt cheap. I would rather pay a fair price for a wonderful company than a cheap price for a garbage company. I am buying this dip. I am locking in that yield. And I am betting on the fact that people will continue to want to live longer, healthier lives. The portfolio strategy, how to combine them. So now you have two stocks, the energy toll booth, high yield, 6%, value, inflation hedge, the healthcare giant, moderate yield, 3%, growth, recession proof. Why do I want both? Because this is what we call a barbell strategy. On one side, you have pure income. On the other side, you have growth and safety. When the economy is booming, the energy stock does well because factories are running. When the economy is crashing, the healthcare stock does well because people still get sick. You are hedging your bets. You are diversified. This is how wealthy people stay wealthy. We don't bet the farm on one horse. We own the racetrack. The do-nothing approach. Now, I want to address the biggest problem you have. You are too active. You tinker too much. You buy a stock, it goes down 5%, and you panic and sell. Or it goes up 10%, and you get excited and sell to lock in profits. Stop it. Real wealth is made by waiting. Charlie Munger, the partner of Warren Buffett, said it best. The big money is not in the buying and the selling, but in the waiting. When I buy these two stocks, I am marrying them. I am not dating them. I plan to keep them for 10, 20 years. I want to collect those dividend checks until I'm in the grave, and then I want my trust fund to collect them for my kids. If they behave, which is unlikely, but that's another story. The tech trap. I know what you are thinking. Kevin, why didn't you choose NVIDIA? Why didn't you choose Tesla? Look, I own technology. I love tech, but tech is volatile. Tech is dangerous. If you put 100% of your money into high-flying tech stocks, you are exposing yourself to massive risk. What if interest rates stay high for 5 years? Tech valuations will get crushed. What if a new competitor invents a better AI chip next year? Your stock drops 50% overnight. You need a foundation. You need a basement before you build the penthouse. These two stocks, energy and healthcare, are your concrete foundation. They are the boring bedrock of your portfolio. Once you have these established, once you have that cash flow coming in, then you can go play with the tech stocks, but not before. If you enjoy this dose of reality, if you appreciate the wonderful truth, then you owe me one thing. Hit that subscribe button for the Cuban Mindset channel. Leave a comment below. Tell me, Kevin, I'm in. Tell me if you prefer cash flow or growth. I read the comments. I want to see who the smart investors are. Get out there. Be disciplined. Treat your money like a soldier. And remember, the only reason to invest is to make money. Everything else is just a hobby. I'm Kevin O'Leary. I'll see you next time.